The financial sector is one of the most important sectors of the Canadian economy, but instead of picking one by one the best Canadian financial companies that are giving you the highest dividend income, what if there was an easier and a better way for you to invest your capital in these giant companies? The good news is that today I'll share with you 3 of the best Canadian banks and financial institutions ETFs that you can buy right now for the long term. So without further ado, let's take a look at my pick number 1. Starting out with the one that is probably considered as the most popular one, which is the BMO Equal Weight Banks ETF with the ticker ZEB. This ETF is tracking the famous Solactive Equal Weight Canada Banks Index, which is composed of the most important Canadian banks that are required to have minimum market capitalization as well as great liquidity screening. The main difference between this type of ETF and the other ones is that this one will be focusing on equal weight ponderation, while the other ones will be more focused on the market capitalization weight. This makes that all the different banks that are available in this ETF have pretty much the same weight. It is why among all of their total holdings, we can find obviously the big 5 Canadian banks as well as the national bank that are all worth between 16 to 17% of the total assets of this fund. This makes that in total, this ETF that has been created in 2009 currently has over $3 billion of assets under its management. And on your side, by investing $10,000 in that fund 10 years ago, this will now be worth over $25,000 or an average annual return of about 9% per year. And by investing in that ETF, you could expect to pay some annual management fees of about 0.28% per year or $28 per $10,000 invest. Add to this, Morningstar is ranking this ETF as being a very aggressive fund that has however been able to outperform the same type of funds of its category while having slightly more risk than them, but with an excellent distribution rate of about 4.50% that is distributed on a monthly basis. This is perfectly representing the companies that are held within this ETF that are known to be high dividend companies that are giving great quality dividend income to their different shareholders. In my opinion, this ETF is pretty much a safe bet for every investor that is looking to invest in the most important Canadian banks. But now let's take a look at another ETF that is also investing in the biggest Canadian banks, but with a quite different approach. And so the second ETF on my list is the BMO Covered Call Canadian Bank ETF with the ticker ZWB. On its side, this ETF created in 2011 has the objective to give you exposure to the biggest Canadian banks as well as earning great income on the different call options premiums. It means that this ETF doesn't only invest in the biggest Canadian banks, but it also buys different call options on it. A call option is a contract between a buyer and a seller that the buyer will be able to buy a certain security for a certain price during a specific period of time. With this scenario, it makes that the buyer of the call options will make profit on this option if the underlying assets that is linked to it will gain value throughout that specific period of time. But on the other hand, if the security lose some value during the specific period of time, it makes that the buyer will lose the price of the options that he has paid initially. It means that by investing in this type of ETF, you are making an extra bet and you are taking some extra risk that the Canadian bank's value will increase during a short period of time. Unfortunately, we can see that over the past couple of years, this bet hasn't paid that much, where we can see that by investing $10,000 in that fund 10 years ago, this will now be worth over $20,500 at the moment, or an average annual return of about 7% per year. However, as you'll see later on in the video, there is one big characteristic where this fund has been able to massively outperform the first BMO ETF. But first, in terms of the asset allocation of this fund, among the 41 holdings of it, we can still see that the first ETF that I've just presented to you represent about 30% of the total assets of it. And then you can find the other big Canadian stocks as well as the call options that are made on them. Plus, on your side, by investing in this ETF, you are investing in a fund that currently has over $3 billion of assets under its management. But at the same time, you can expect to pay some slightly higher management fees compared to ZEB of about 0.71% per year or $71 per $10,000 invest. These higher fees comes from the fact that the fund manager of this fund must pay pay a lot more money and it is costing a lot more to them to have the different call options in it. But the excellent news about this fund is that they are able to give some massive monthly dividend distribution of over 7% per year. And so this means that if you're looking to earn even more passive income, this type of ETF could be particularly interesting for you. And even if this fund is categorized by Morningstar as being a very aggressive fund, it has been able to achieve the same level of return compared to the average funds of its category while having less risk than them. And finally, the last ETF on my list is the iShares Canadian Fixed Monthly Income ETF with the ticker FIE. On its side, this ETF doesn't only seek to have exposure to the big Canadian banks, but also to the overall financial sector. At the same time, this ETF doesn't only have a diversified portfolio of common shares, but also different preferred shares as well as common bonds that have been issued by the Canadian financial companies. It is why we can notice that only by itself, the iShares S&P TSX Canadian Preferred Shares Index ETF currently represents over 20% of the total assets of this ETF. Preferred shares are simply shares from a company's stock that will be paying their dividends before the common stock's dividend. This investment vehicle is known to be a mix between the features of a bond and of a common share. Indeed, the preferred shares will tend to offer more stability to the investors and higher claim in case that the company would go to bankruptcy. However, this type of security will also tend to gain less value compared to the common shares, and they will also give no voting rights to their owners. And so it makes that these types of investment vehicles will give you more stability in your overall portfolio by giving you also more diversification. Nevertheless, when we come back to the asset allocation of our fund, we can find that they also have high exposure to the core Canadian bond ETF from their own company. And then with no surprise, we find the stocks of some of the biggest Canadian banks as well as other big financial institutions in the country such as Manulife. In total, only by itself, the bank sector represents over 40% of the total assets of this ETF. And then we can find that the insurance and the financial services sectors are the two other sectors that are well present in this ETF that currently has over $1 billion of assets under its management. Plus, by investing $10,000 in this fund 10 years ago, this would now be worth over $20,000 or an average annual return of about 7% per year. And then on your side, by investing in this ETF, you could expect to pay some annual management fees of about 0.85% or $85 per $10,000 invest. So slightly more fees compared to the two other ETFs on my list for this fund that is categorized by Morningstar as being an aggressive fund, which has however quite more risk compared to the average funds of its category, while still being able to outperform them on the long term. Nevertheless, this iShares ETF is still able to offer some impressive monthly income distribution of over 6.50% per year. So this could be an interesting ETF for the investors that are looking to not only track the big Canadian banks, but all the financial market in the country with different investment vehicles. As you've been able to see in this video, these types of financial ETFs are ideal for the investors that are looking for high dividend income and more stability in their overall portfolio. However, these types of ETFs might not be optimal for you if you're looking for high growth in the long term. So on your side, if your objective is to grow your capital as much as possible for the next 10 to 40 years, well, check out the video that's gonna be right over here, and I will see you soon. Peace.